Commentary on the introduction. If you have built castles in the air, your work need not to be lost. That is where they should be. Now put on the foundation under them. Notice that Graham announced from the start that this book will not tell you how to beat the market. No truthful book can. Instead, this book will teach you 3 powerful lessons. How can you minimize the odds of suffering irreversible losses? And how can you maximize the chance of achieving suitable gain? How you can control the self-defeating behavior that keep most investors from reaching their full potential. Back in the boom years of the late 1990s, when technology stocks seemed to be doubling in value every day, the notion that you should lose almost all your money seemed obstructed. But by the end of 2002, many of the dot-com and telecom stock had lost 95% of their value or more. Once you lose 95% of your money, you have to gain 1,900% just to get back to where you started. Taking a foolish risk, it can put you so deep in the hole that it's virtually impossible to get out. That's why Graham constantly emphasizes the importance of avoiding losses, not just in chapters 6, 14, and 20, but in the thread of warning that he was woven throughout his entire text. But no matter how careful you are, the price of your investment will go down from time to time, while no one can eliminate that risk. Graham will show you how to manage it and how you can get your fears under control. So, are you an intelligent investor? Now, let's answer a vitally important question. What exactly does Graham mean by intelligent investor? So back in the first edition of this book, Graham defined the term, and he made it clear that this kind of intelligence has nothing to do with IQ or SAT score. It is simply mean being patient, disciplined, and eager to learn. You must also be able to harness your emotion and think for yourself. This kind of intelligence, explained Graham, is that they trait more of a character than of a brain. That proved that high IQ and high education are not enough to make an investor intelligent. In 1998, Long-Term Capital and Management, LP, a hedge fund run by a battalion of mathematicians, computer scientists, and 2 Nobel Prizes winning economists lost more than $2 billion in a matter of weeks on a huge bet that the bond market would return to normal. But the bond market kept right on becoming more and more abnormal, and the LTCM had borrowed so much money that its collapse nearly capsized the global financial system. And back in the spring of 1720, Sir Isaac Newton owned share in the South Sea Company, the hottest stock in England, sensing that the market was getting out of hand. The great physicist muttered that he could calculate the motions of heavenly bodies, but not the madness of the people. Newton dumped his South Sea share, pocketing a profit totaling 7,000 euro. But just a month later, swept up in the wild enthusiasm of the market, Newton jumped back in at a much higher price and lost 20,000 euro, or more than $3 million in today's money. For the rest of his life, he forbade anyone to speak the word South Sea in his presence. Sir Isaac Newton was one of the most intelligent people who ever lived, as most of us would define intelligent, but in Graham terms, Newton was far from an intelligent investor. By telling the dwarf Crown overrode his own judgment, the world's greatest scientist acted like a fool. In short, if you failed in investing so far, it's not because you're stupid. It's because, Sir Isaac Newton, you haven't developed the emotional discipline that successful investing require. In chapter 8, Graham described how enhances your intelligence. By harnessing your emotion and refusing to stop the market level of irrational originality, there can master his lesson that being an intelligent investor is more a matter of character than brain. A chronicle of humility. Now let's take a moment to look at some major financial development of the past few years. The worst market crash since the Great Depression, with U.S. stock losing 50.2% of their value, or $7.4 trillion between March 2000 and October 2002. Far deeper drop in the share price of the hottest companies of 1990s, including AOL, Kisto, GDS, Unifaces, Lucent, and Qualcomm. Please, the utter destruction of hundred and internet stock, accusation of massive financial fraud at some largest and most respected corporation in America, including Enron, Teco, and Xerox. The bankruptcy of the rich one's glistening company as Consesco, Global Crossing, and WorldCom. 5. LH and the accounting firm cooked the book and even destroy record to help their client mislead the investing public. 6. Charge that top escalation in leading companies sick phone of hundreds of millions of dollars for their own personal gain. 7. Proof that security analyzed it on Wall Street praised stock publicity but admitted privately that they were garbage. 8. A stock market that even after its blood-curdling decline seemed overvalued by historical measure, suggesting to many experts that stock are further yet to fail. 9. A relentless decline in interest rate that has left investors with no attractive alternative to stock. 10. An investing environment brewing with unpredictable maintenance of global terrorism and war in the Middle East. Much of the damage could have been and was, much of the damage could have been and was avoided by investors who learn and live by Graham principle. As Graham put it, while enthusiasm may be necessary for great accomplishment everywhere, on Wall Street, it almost invariably leads to disaster by letting themselves get carried away on on internet stock, on big growth stock, and on stock as a whole. Many people made the same stupid mistake as Sir Isaac Newton. They let other investor judgment determine their own. They ignored Graham's warning that the really dreadful losses always occurred that after. The buyer forgot to ask how much, most painfully of all, by losing their self-control, just when they needed it the most. These people proved Graham a saturation. The investor chief problem and even his worst enemy is likely to be himself. The sure thing that wasn't. Many people got especially carried away on technology and internet stock, believing that high-tech hype that this industry would keep outgrowing every other for years to come, if not forever. In mid-1999, after earning a 117 and 3.3% return in just the first five months of the year, Monument Internet Fund portfolio manager Alexander Tranch predicted that this fund would gain 50% a year over the next 3 to 5 years and an annual average of 35% over the next 20 years. After his Amerindo technology fund rose an incredibly 248 and 9/10% in 1,999, portfolio manager operated below anyone who dared adopt the internet was particularly money-making machine. If you're out of sector, you're going to underpose form. You're in horse and buggy, and I'm in Porsche. You don't like tenfold growth opportunity, then go with someone else. In February 2000, a hedge fund manager, James J. Cramper, proclaimed that internet-related companies are only one worth owning right now. These winners of the new world, as he called them, are the only ones that are going higher constantly in good days and bad. Graham Kramer even took a pot shot at Graham. You have to throw out all the metrics and formula and the text that existed before the web. If we use any of what Graham and Don teaches, we wouldn't have a dime under the management of these so-called experts. Ignored Graham's sober word of warning. Obvious prospect of physical growth and a business do not translate into obvious profit for investor. While it seems easy to foresee which industry will grow the fastest, the foresight has no real value if it's most other investors are already expecting the same thing. By the time everyone decided, the best one to invest in the price of its stock have been bid up so high that in future return have nowhere to go but down. For now at least, no one has the gall to try and claiming that technology was still in the world's greatest growth industry. But make sure you remember this. The people who now claim the next sure thing will be health care or energy or real estate or gold are no more likely to be right in the end of the hipster but of high tech turn out to be. Their silver lining, if no price seemed too high for the stock in the 1999. In 2003, we reached the point at which appeared low enough to be low enough. The pendulum was swung on Graham. As Graham always does, the original expert of adjustable prism. In 2002, investors gained $27 billion out of stock mutual funds, and a survey conducted by the Securities Industry Association found that 1 of the 10 investors had cut back on stock at least 25%. The same people who was eager to buy stock in the late 1999s when they were going up in the price and therefore becoming expensive, sold stock as they went down in the prices and by definition become cheaper. As Graham shows so brilliantly in chapter 8, that's exactly backward, the intelligent investor realized that stock become more risky, not less, as their price rests, and less risky, not more, as their price fall. The intelligent investor dread a bull market, since it makes stock more costly to buy. And conversely, so long as you keep another cash on hand to meet your spending need, you should welcome a bear market, since it put on the stock back on the sale. So take heart. The death of the bull market is not the bad news everyone believed it to be. Thanks to the decline of the stock price, now it is considerably safer and saner to be building wealth. Read on and let Graham show you how. Tomorrow we will read chapter 1.